Thanks for joining us at this last Magellan briefing for 2016. Today I'm speaking with Gerald Stack, the Head of Infrastructure Capabilities and Portfolio Manager. Gerald, the US President-elect has made some initiatives around infrastructure spending to the tune of $1 trillion. What impact does this have on your portfolio?
Look, in short, we think the impact is somewhat immaterial. Let's be honest, the detail on the $1 trillion plan is scant at best, but from what we can see, to the extent that there will be an impact that involves the private sector in terms of ownership of assets, then we would expect most of those opportunities to go to unlisted infrastructure asset owners rather than the listed infrastructure universe. So within our universe in the US, which is regulated energy utilities, regulated water utilities, rail, US rail and telecommunication tower companies, there may be opportunities, but we think they're pretty much at the margin. And therefore the impact on our portfolio today of the plan is pretty limited. We would think the plan offers significant benefits for construction companies, but we deliberately exclude construction companies from the way that we define the investment universe.
And so, Gerald, what does the US President mean for the regulatory environment in the US?
So again, detail is scant at this point. I guess we would look to Trump's administration and think that it's broadly encouraging of business and expansive towards business. In terms of regulated utilities, both water and energy, though, we would think that the impact would be pretty limited. Ultimately, the key part of the investment framework for a regulated utility, water or energy, is the regulator, and we don't see any material impact on regulators. Indeed, regulation in the US for utilities is administered on a state basis. So there's 50 different regulators. There is a federal regulator for businesses that cross state lines, but that's a relatively small impact in the scheme of things. For your typical regulated utility, the key driver is your local regulator, and essentially regulated utilities have a compact with their community. They will invest large sums of money for the future to ensure reliable and efficient service, and in return they are allowed to earn a fair return. And a fair return in the US at the moment, according to the different regulators, averages about it's somewhere in the 9.5% to 10% range. We don't expect a material change to that over time. That rate of return will rise and fall, we would expect, with bond rates and with inflation. You're protected from those issues, but we don't expect that a new federal government administration, the Trump administration, to have a material impact on that. So as we see it, for the regulated utilities, life continues pretty much as is.
And so, Gerald, we've seen a spike in longer term yields from the US. Does this have an impact on your portfolio, and are you making any particular tilts within the portfolio because of that spike?
So I guess I'd think about the impact in terms of three issues. The impact on the businesses of an increase in bond rates, the impact on value, on intrinsic value of an increase in interest rates, and then the impact on market price. So the impact on the businesses themselves is pretty limited. The bulk of the businesses that we invest in have taken the opportunity of the last 5 years, where interest rates have been extremely low, to lock in their debt exposures over a long duration. So the bulk of them have got long-dated debt maturities at very low rates, and indeed on our analysis, the bulk of the companies that we look at, even with an increase in rates, their average cost of debt will continue to decline for the next 3 to 5 years, because the debt that they're rolling over, the debt that they're replacing, is debt that was raised in sort of 2010, 2011, where rates were much higher. So the impact on the interest expense of the companies that we look at is pretty limited. And indeed, for the foreseeable future, we actually expect debt costs to continue to decline. So that's the impact on the business. The impact on intrinsic value, we value in the US, we value assets on the basis of a 4% risk-free rate. We value all assets at the end of the day with reference to the risk-free rate. And the risk-free rate that we're using in the US at the moment is 4% nominal. That compares to the prevailing bond rate. Today, the US 10-year government bond yield of 2.4%. Now, roughly a quarter ago, that rate was around about 1.7 to 1.8%. So the long end of the yield curve, the 10-year government bond yield, has increased by something like 60 to 70 basis points over the last quarter. So there's been an increase in those bond rates. But when we value companies, we're actually using a 4% reference rate. So we have expected for some time that interest rates would rise. We have allowed for that in our valuation. We believe 4%, today we believe that 4% is a fair rate of return for an investor in a risk-free asset in the US, and therefore when we value assets in the US, we do it with reference to that. So the conclusion from that answer is yes, rates have risen, but the impact on intrinsic value for us is actually immaterial at best. So impact on the business, limited to immaterial. Impact on valuation, as we see it, limited to immaterial. The impact on market price, though, has been significant. We've seen our universe decline by approximately 5% in market price over the last quarter. And that has provided us with a range of different opportunities. There's a number of high quality businesses out there that we've liked for a long period of time that all of a sudden look a lot cheaper, look a lot better opportunities to us than they did a quarter ago. And as a result of that, we're moving our portfolio around to reflect some of those opportunities. So, you know, it's 3 impacts: limited impact on the business, limited impact on valuation, material impact on market price, and we're looking to participate in that, to benefit from that.
Gerald, the relative performance of the infrastructure strategy has struggled over the last little while. Is it as a result of the stocks that we own, or potentially some of the stocks that we don't own?
Yeah, look, our performance versus the index has not been what we would like it to be over the last little while. That's very much a consequence of the stocks we don't own. In particular, stocks related to the oil price, MLPs and the like, competitive energy stocks. Now, this has been in a period in which the oil price has risen from lows to sort of approximately $50 a barrel now today, and that's hurt us. That affects a number of companies that are classified in the broader infrastructure universe as infrastructure stocks, but they have a direct linkage to the oil price in terms of their revenues and their earnings. Absolutely, that's hurt us. We exclude those stocks. We exclude any stock that has where we assess that more than 25% of their earnings are related to the oil price. Now, what that means is we can be confident that earnings will be reliable over the long term, because we're just not in the business of forecasting oil prices. But that has hurt us in the last quarter. However, if I look back over the last couple of years, that's been a significant relative value add for our strategy. We've performed very well over the last 2 to 3 years, and in an environment when oil prices are falling. And ultimately, in terms of our absolute returns, what it means is our absolute returns are not affected by oil prices. We may get affected relatively up or down in the short term, but in the long term, we're seeking to deliver investors very reliable returns. And one of the ways that we do that is by excluding companies and stocks with exposure to oil prices.
And so, given the volatility recently, what steps are you taking in the strategy to make sure that it remains defensive?
So we've certainly seen plenty of market volatility. What we seek to do is to deliver ultimately a very defensive investment returns over a 3 to 5 year time frame. And essentially we do that by seeking to only invest in companies with very defensive earnings, very reliable earnings. And indeed, as we've touched on already today, the earnings in the companies that we're investing in are very much unaffected by much of what's caused some of the market volatility in the last little while, both politics, interest rate rises and so on. So the earnings of the companies that we're investing in are highly defensive. The share price is not necessarily so. And so what we've sought to do is to, where stocks have become attractive on a valuation basis, we're looking to participate in some of that. We've been able to buy what we would regard as extremely high quality companies at prices that were materially below what they were 3 months ago. And we're looking to move the portfolio towards some of those opportunities. And that's the way we'll continue to do so. We'll look to ensure at all times that the portfolio comprises companies and stocks with highly defensive earnings, and ultimately value is a function, as we see it, of 2 things: expected cash flows and risk. We're very confident about the expected cash flows. The market may take a different view for us in the short term about risk, but we're confident that in the long run these companies are low risk, and that will be reflected in valuation.
Thanks, Gerald.
Thanks, Frank.
And thanks for watching. We wish you a safe and happy festive season and look forward to catching up in 2017. Thanks.